Hi students, can you hear me properly? Is my voice is audible to everybody? From today onwards, I am going to start a new concept relating to accounting treatment of the goodwill as per AS-26. These videos are only relating to PUC2, Karnataka PU Examination Board. For CBSE and ISC, I am making separate video for the accounting treatment of goodwill because they are using the word premium for goodwill account. Okay, so ICAI and PUC are following the same pattern. That's why these videos are relating to PUC2 accountancy. So that too specifically for the accounting treatment of the goodwill as per AS-26. Let us start. What is the concept of AS-26? Concept of accounting treatment of goodwill as per AS-26. Goodwill. Adjustment of goodwill as per AS-26. The first point everybody keep in your mind, while you are reading the accounting standards, you have to focus on each and every technical terms used in the definitions or provisions. Point number 1, internally generated goodwill. It means that there are two types of goodwill. One is self-generated goodwill, that is called internally generated goodwill. Another one is purchased goodwill. I told you there are two types of goodwill. One is self-generated goodwill, another one is purchased goodwill. Now we are discussing about the internally generated goodwill. So internally generated goodwill should not be recognized as an asset. So what it is saying, self-generated goodwill or internally generated goodwill should not be recognized as an asset because it is not an identifiable resource. We can't identify the goodwill, just it is an imagination controlled by the enterprise. When it is not identifiable, how can the enterprise can control it? That can be measured in realizable cost. There are 3 points in this definition or in this sentence. One is self-generated goodwill should not be recognized as an asset. Why? There are 3 reasons. One is it is not an identifiable resources. Second point is it is not controlled by an enterprise. Third point, it cannot be measured reliably. That's why internally generated goodwill should not be recognized as an asset because it is not an identifiable resource controlled by an enterprise that can be measured reliable at cost. Second point, hence that's why when goodwill is evaluated at the time of any change in the constitution of the firm, we are saying changes in the constitution of the firm means change in the profit sharing ratio, admission of a partner, retirement of a partner, death of a partner. So this is called reconstitution of the partnership firm. In these situations, the value of such goodwill should not be realized in the books of the firm. Rather, the value of such goodwill adjusted through the concerned partner's capital accounts or current accounts. The summary of this AS-26 relating to the part of the AS-26 relating to reconstitution of the partnership firm is like this. First point, they are saying that intergenerated goodwill. Internally generated goodwill is also called self-generated goodwill. It should not be recognized as an asset. There are 3 reasons because number 1, it is not an identifiable resource controlled by an enterprise. Second one, it cannot be measured at a reliable cost. And next point is how to treat it. It is adjusted through the partner's capital account or current account. I think everybody understanding the concept. Let us move on to the concept number 1. Concept number 1. If in the question, that is in the problem, OPSR means old profit sharing ratio and new partner profit sharing ratios are given and new partner bring the cash for goodwill and goodwill amount is retained in the business by the old sacrificial partners. So this is the type of question I am explaining by title. I told you in the question what is the first information, old property sharing ratio and new partner property sharing ratio is given, and if the new partner bring the cash for goodwill, and that goodwill amount is retained in the business. Let us read the question. Mr. A and Mr. B are partners in a firm. In this partnership firm there are two partners, Mr. A and Mr. B. Because the term used is are. Sharing profits and losses in the ratio of 3:2. What is their profit sharing ratio? 3:2. We call it as a OPSR, old profit sharing ratio. Their balance sheet as on 31st/3/2024. You make it as a 24. By mistake it was 20. Now you make it as 24. Was as follows. Okay, I'll make it changes. Okay, let us start. Balance sheet of Messrs. Mr. A and Mr. B as at 31st/3/2024. So I told you in the above you make it as a this 20, you make it as a 24. Balance sheet, draw the balance sheet like this. Capital and liabilities amount rupees, assets amount rupees. Capital Mr. A, Mr. B. Because it is an old balance sheet, in the old balance sheet only the old partner's name will appear. Cash or bank, because when the new partner bring the cash for goodwill, we are adjusting through it a cash or bank. On 1/4/2024, they admit Mr. C into the partnership on the following terms. Now we come to the conclusion that this question is relating to admission of a partner. Now, who are the old partners? Mr. A and Mr. B. What is the old profit sharing ratio of Mr. A and Mr. B? 3:2. What is the old balance sheet date? 31st/3/2024. I told you make it 24. And the date on which new partner is admitted into the partnership firm on 1/4/2024. Who is the new partner? Mr. C. Number 1. Mr. C should bring in cash rupees 25,000 as his capital and 15,000 goodwill for 1/5 share in the future profit. Now, in this adjustment number 1, there are two parts. One is he brought the 25,000 for the capital and 15,000 for goodwill. Now we are not focusing on the capital, we are focusing only on the goodwill, because these are the concept we are focusing only towards the adjustment of goodwill, accounting treatment of goodwill as per AS-26. Show the accounting treatment of the goodwill as per AS-26 by preparing the partner's capital accounts and cash or bank account. I am connecting this question from old balance sheet to the accounting treatment of goodwill and lastly to the new balance sheet. I think everybody understanding this question. So pause the video and note down the question. Afterwards we will start to the solution. Let us start. Solution to concept number 1. WN1 means working note number 1, calculation of sacrifice ratio. Instead of using the word calculation of sacrifice ratio, you just use sacrifice ratio. So if in the question only OPSR and new partner share are given, the OPSR itself become the sacrifice ratio. What I am telling you, if in the question OPSR and new partner profit sharing ratio are given, in such a cases, what is the sacrifice ratio? The OPSR itself is the sacrifice ratio. I'll make a separate video for calculation of sacrifice ratio and NPSR. There we will discuss in deep way. Ready? Now, sacrifice ratio is equals to Mr. A ratio Mr. B. Sacrifice ratio is equals to 3:2. Next, working note number 2. Accounting treatment of goodwill as per AS-26. Journal. Draw the format like this. Date, particulars, LF, debit, amount rupees, credit, amount rupees. Now, step number 1. When the new partner bring the cash for goodwill, accounts involved are one is cash account, another one is new partner's capital account. As per American accounting system or accounting equation approach, cash account is a asset account. When the new partner bring the cash for goodwill, increase in the asset, debit. Increase in the cash, increase in the asset, debit. Cash account, debit. How much amount? 15,000. This amount is adjusted through the new partner's capital account. So second account involved is capital account. Capital account, increase in the capital, credit. Increase in the capital, credit. So now we are adjusting through the capital account, means it is added to the new partner's capital account. That's why increase in the capital, credit to Mr. C's capital account. Amount 15,000. Being cash brought in by Mr. C for his share of goodwill credited to his capital account. If you want to know the rules of debit and credit as per the England system or British system, cash is a real account, debit what comes in debit. Mr. C's capital account is a personal account, credit the giver of the benefit, credit. I think everybody understanding it. Pause the video and note down it. This is step number 1. Let us move on to the step number 2. Step number 2. Now we have to distribute this goodwill, apportion this goodwill between or among the old sacrificial partners capital account. So now we have to close the Mr. C's capital account. Means not to close, means we have to transfer this 15,000 goodwill from Mr. C's capital account to sacrificial partners capital account. So when you are adjusting this amount, earlier you credited the Mr. C's capital account. In order to adjust the C's capital account, now you have to debit it. It is adjustment entry, not as per debit what comes in, credit what goes, increase in the asset, decrease in the capital, not like that. It is adjusting entry. Means which account we are adjusting? Mr. C's capital account. Earlier it was credited, now it should be debit. Mr. C's capital account, debit. Amount 15,000. This 15,000 is apportioned or distributed or adjusted to the old sacrificial partners in their sacrifice ratio to Mr. A's capital account. Total 15,000. Sacrifice ratio is 3:2, 3/5, means 3 plus 2 is 5. It is 9,000 to Mr. B's capital account. 15,000. Sacrifice ratio is 3:2 and B share is 2. 2 plus 3, 5. 2/5. It is 6,000. Being cash brought in by Mr. C credited to old partner's capital account in the sacrifice ratio of 3:2. I think everybody understanding it. Sorry. So when the new partner bring the cash for goodwill, 2 steps are involved. Step number 1, cash account debit to Mr. C's capital account. Being cash brought in by Mr. C for his share of goodwill credited to his capital account. Step number 2 is to apportion the goodwill among or between the old sacrificial partners capital account. So Mr. C's capital account debit to Mr. A's capital account to Mr. B's capital account. I think everybody understanding it. It is the case number 1. Pause the video and note down it. Partners capital account. Draw the format like this. Partners capital account, particulars, Mr. A, Mr. B side. When the new partner bring the cash for goodwill, what is the journal entry? Keep in your mind, cash account debit to Mr. C's capital account. Now we are preparing the partner's capital account. So capital account is credited. That's why Mr. C's capital account is credited by cash account. Goodwill, working out number 2, step number 1, 15,000. So everybody understanding it? Once again I am explaining. What is the journal entry? Cash account debit to Mr. C's capital account. Now we are preparing C's partner's capital account. Capital account is Mr. C's capital account is credited by cash account. Next, step number 1 is completed. Step number 2 is that we are apportioning this goodwill between or among the old sacrificed partners capital account. So in such a cases, what is the entry? Mr. C's capital account debit to Mr. A's capital account and to Mr. B's capital account. Mr. C's capital account debit to Mr. A's capital account goodwill in sacrifice ratio of 3:2, 15,000 into 3 by 5. The working note number 2, step number 2, rupees 9,000. Whose capital account debited? Mr. C's capital account debited. That's why you have to write in the C's column. Whose account is debited? C's capital account is debited to Mr. B's capital account. You make it as a B. 1 minute. I want to make it as a B. Okay, 1 minute. Okay. Here also making it as a 24. I think everybody understanding it. Come to capital account. To Mr. B's capital account, goodwill amount in the sacrifice ratio of 3:2, 15,000 into 2 by 5. Make it as a 2 by 5. I'll make it as a 2 by 5. 1 minute. Now, step 1 is cash account debit to C's capital account. C's capital account is credited. That's why I'm writing on the credit side. C's capital account is credited by cash account. Right in the C's column. Step number 1. If you want to check it, you can go back and check in the journal entry. Second step, C's capital account debit to Mr. A's capital account rupees 9,000 to Mr. B's capital account rupees 6,000. This is as per step number 2. Okay, but in this format, Mr. A, Mr. B, Mr. C, all persons capitals are in the same format, just like a 3-column cash book. So this entry is contra entry. Now you have to reverse the entry. What is the entry? Active, in the active manner, C's capital account debit to A's capital account to B's capital account. If you want to make it passive wise, Mr. A's capital account is credited, Mr. B's capital account is credited by Mr. C's capital account. That's why Mr. A's capital account and Mr. B's capital account are credited by Mr. C's capital account. Goodwill amount, working out number 2, step number 2 in the sacrifice ratio 3:2. Sorry, Mr. A 15,000 into 3 by 5, it is 9,000. Mr. B 15,000 into 2 by 5, it is 6,000. So whatever you have passed the entry on the debit side, its reverse is on this credit side. Mr. C's capital account debit to A's capital account to B's capital account. Mr. A and B's capital accounts are credited by Mr. C's capital account. If you want to pass the entry as per the rules of debit and credit, you have to pass the entry like this. Otherwise, you can randomly remember it like that. When the new partner bring the cash for goodwill, buy cash, right on the credit side. Next, you distribute the goodwill to sacrificed partner's capital account in the new partner column, sacrifice in the sacrifice ratio. Reverse by new partner capital account, but in the old sacrificed partner's capital account column. So I think everybody understanding it. Next, if anybody want to note down it, pause the video and note down it. bank account. Next step, bank account. Why? When the new part bank or cash, you make it as a bank or cash or bank. I'll make it as a cash or bank. Okay, cash slash bank. One minute. Let us start. Cash or bank account. When new partner bring the cash for goodwill, what is the journal entry? Cash or bank account debit. If in the question cash is given, cash account debit. Bank is given, bank account debit. Cash or bank account debit to Mr. C's capital account. But when you are starting the cash or bank account, first you write the opening balance that is given in the old balance sheet. Now our focus is on only relating to the goodwill account treatment. Okay, first you write the brought down amount. Next, if the new partner bring the cash for goodwill, what is the entry? Cash or bank account debit to Mr. C's capital account. It means that cash or bank account is debited. That's why you have to write on the debit side. Cash or bank account debit to Mr. C's capital account. Goodwill amount, working number 2, step number 1. Amount is 15,000. Okay. Next, you have to total on the higher side, bring it to the lower side, arrive the difference. The difference is carried down. Now we are focusing only on the accounting treatment of goodwill. So that's why I am not considering the amount of the brought down or carried down anything else. Just we are focusing on accounting treatment of goodwill. When the new partner bring the cash for goodwill, the step number 1 is cash or bank account debit to Mr. C's capital account. Means cash or bank account debit to new partner capital account. Pause the video, note down it. Last step is to prepare the new balance sheet. New balance sheet sorry, of Messrs. Mr. A, Mr. B and Mr. C. As on 1/4/2024, you make it as at. New balance sheet, capital and liabilities amount rupees, assets amount rupees. Capital. Now there are 3 partners, Mr. A, Mr. B, Mr. C, as per the partner's capital account. Okay. Thanks for everybody's cooperation and support. So I am making the separate video. It is completely in English. For Kannada and English, I will make a separate video for the PUC. For CBSE and IS, I will make completely only in English. Okay. If you are understanding the concept, please like the video, share, subscribe it and press the bell icon, because the motive is to everybody should get the quality education in a free of cost. So in the comment box, if you are facing any difficulty, you write your comment in the comment box. Okay. Thank you.